Coming up here, let's talk about the bigger picture. Michael Jones is with us, Chairman and CEO of Caravel Concepts. Thank you, Michael, for being here. So your thoughts on what we've heard from Jay Powell. It's funny because sometimes we get comments and the market reacts one way, and then we get comments and the market reacts the other way, when really things haven't really changed that much. What's going on here?
The market's caught in a bit of schizophrenia because the market is looking at things like the longer-term trend of the last 3-6 months in oil, the last 3-6 months in copper, in lumber, and it's seeing money supply growth actually turning negative, going from a peak of 25% to right now about 4% growth year over year. All of those suggest that we're starting to get past the worst of the inflationary problems, and maybe it's time to start buying again. And then Fed Chairman Powell makes some statement that says we still have a long way to go. There's a lot of tightening ahead of you. There is pain, suffering. Just get ready for it. So the market's kind of pinging and ponging between what it sees in the forward-looking indicators of inflation and what it hears from the folks who get to determine how high interest rates are going to go. And they say we're just getting started because of the things we're looking at have not yet started to flash those anti-inflationary signals.
Yeah, and you know what's interesting too? I mean, just a reminder, Jay Powell even noted that some of this takes time to filter into the system. He even said it, some of the rate hikes that we've done now, we haven't even fully seen their effects yet, but they're full force. We know that they were trying to front load. Are you expecting 75 basis points, and what after that?
I think given the hawkishness of the tone of his Jackson Hole speech and a lot of the other Fed governors and people who are going to be participating on the FOMC vote, I think they're all sounding very hawkish, and I would put my money behind the 75 basis points. I don't see the need to go on for 100 basis points and shock the market. But at the end of the day, as I see the transition that has happened under Fed Chairman Powell in the Fed, is that they've completely abandoned the monetary view of inflation that helped guide the Fed and got us all out of the inflationary mess of the 70s. They say money supply is no longer an accurate gauge of inflation. They're focused on wage pressures, and they want unemployment to go up because they think that's going to lower unit labor costs. The problem is that companies right now are hanging on to workers. They just spent 2 years not being able to attract enough skilled workers, and they're not firing at the first hint of a slowdown. And that means that to Fed Chairman Powell, there needs to be a lot of increases in the unemployment rate and in the jobless claims numbers before they think they are done tightening.
Yeah, and so at this point now, you're saying there's action that we can take. I guess there has to be some caution based on the fact that you do have a rising rate environment. Are you buying? Are you selling? Which one should we start with?
So first of all, you've got to believe, as Caravel does, that the old monetary tools, they still work. You print too much money, the Fed and the private sector banking system, you print too much money as they did in 2020 and 21, you get inflation. When monetary growth collapses, as it has in the last 6 to 8 months, that's going to mean that inflation pressures are going to start coming down. If you believe that, and I think we get a lot of support from that view in what's happened with oil and copper and lumber and so forth, I believe if you believe that view of inflation says we're getting past the worst of this, then you start buying the 10-year Treasury every time it gets close to 350. You buy the 20-year Treasury every time it gets close to 375, because the collapse in money supply happened about 3 to 6 months ago, and it's continuing apace. If we have that typical 12 to 18-month lag, we're going to start seeing inflation coming down significantly about 9, 12, 15 months out. And if that happens, 350 on the 10-year is going to look really, really good. Also, the Fed is going to keep tightening, and we're going to see the yield curve invert further, in my estimation. And we're also possibly going to get a big deflationary shock out of China because the Chinese property markets continue to collapse. No one's really talking about how that's going to impact the global inflationary picture as China's economy continues to come unglued. If we're right on all that, then you'd also, the value trade's been a great one. We promoted it aggressively in the end of 2021. It's time to reverse that. I wouldn't go net long equities yet, but I would definitely take the profits from being out of growth and into value. I would swap that trade. And actually, if you want to improve the portfolio and as you reverse that trade, I would go from value to quality. Quality tends to outperform growth significantly over the long run and probably has a little less volatility in the kind of tightening environment that we're anticipating.
And when you're looking for quality, is something in the commodities quality? Is it something like energy? Or what are you looking for?
Fortunately,
commodities, something you like?
I think commodities are going to be suffering from the tightening Fed. I do believe that we may see Fed Chairman Powell be the first Fed chairman in history to run the U.S. economy off the cliff in both directions, by both giving us inflation by overstimulating and giving us a recession by over-tightening. A recessionary environment's not good for commodities, and it's not good for the energy space. So personally, I would be looking to start. That's been a fantastic trade. It's been a great run. It's time to probably start taking profits in that space and moving back into some of the high-quality, beaten-down growth names that are well off their highs of 12, 18 months ago.
Wow. Great to chat with you, Michael Jones. Nice to speak with you. Thank you. Caravel Concepts. Until next time, we'll get an update from you. Thank you so much.